Welcome to another informative session on retirement income strategy. In our last session, we went over how $1 million portfolio was a good number to retire comfortably by following a phased approach to retirement income generation. Today, we will be looking at various retirement income sources and manage your withdrawals to fall in the most optimum tax bracket. We will look at ways to save on your taxes by planning a post-retirement withdrawal strategy for a $1 million portfolio. So here are a list of things you need to know before you plan your retirement portfolio. What is your tax bracket now and what will it be during your retirement years? Income sources during retirement years to help plan your withdrawals. Income sources that qualify for tax-free withdrawal. Your applicable income deductions post 65 years. And what is your required minimum withdrawal to avoid penalty? You need to understand the disadvantage of landing in a higher tax bracket on retirement. So let's understand the income tax bracket for single filers as well as married filers. Now, if you want to remain in the 10 or 12% income tax bracket, you need to limit your withdrawals to $50,400 if you're single. And in case of married filing jointly, you need to limit your withdrawals to under $100,000 if you want to stay within that 12% tax bracket. If your needs for income is higher than 100,000, then there are chances you will go into the 22% tax bracket if you do all your withdrawals from your taxable accounts. And this is where our strategy of withdrawal comes into picture. How you plan to withdraw from your different accounts can drastically reduce your taxable income, and that's what we're going to see next. Historically, it is seen that we enter into a lower tax bracket post-retirement, considering us withdrawing lesser amount from our 401ks, Roths, brokerage accounts to satisfy our lower monthly needs. Another reason being the revised tax bracket will have a raised limit than today's to account for inflation. Hence, if you are currently in the 22 or 25% tax bracket, it is most likely that you will go into a lower tax bracket, which could be 12% or 22% during retirement, or even 0%. However, this might not be applicable to all, and it will solely be based on your retirement withdrawal needs to support your lifestyle choices. So let's look at the different retirement income sources. We all know about the 401k retirement account. We then have our brokerage accounts if we have invested in stocks, ETFs. And we also have income generating assets. Not all of us might have this, but some of us will. And these would be real estate, rental properties, commercial property incomes, dividend income, or any other side hustles that you're doing during your retirement. Traditional IRA, Roth IRA, and health savings account. So these are some of the accounts which are going to generate income for you post-retirement. So the 401k, the brokerage accounts, income generating assets, and the traditional IRA, they're all going to incur tax when you withdraw money from these accounts. Whereas the Roth IRA and the health savings account are completely tax-free withdrawals. So let's look at a possible withdrawal strategy from our different retirement accounts and how it dictates the applicable taxes, and also look at the applicable deductions. In my last video, I have explained step-by-step process of generating income during these retirement years, and also shown you how we have divided our retirement into 3 phases and 3 different buckets which is going to provide you an income during these 3 phases. So the first phase, we will generate income anywhere from 90 to 100k. The second phase is going to be 75 to 80k, and third phase is going to be need-based. And please watch the video that was uploaded last week to know how these calculations occur, and these calculations are considering a withdrawal rate at 10 to 12% in phase 1, then going to 5% in phase 2 and 4% in phase 3. Also, your savings or your investments are continuing to grow at the rate of 7% in all these 3 phases. As you see, we started with $1 million portfolio, but we kept $250,000 for it to grow. And then we used the $750K to generate income during your phase 1 and phase 2. We have a 401K, a Roth, giving you stable income during your phase 1, along with dividend income, any rental incomes, which are basically optional. It's based on you having invested in stocks, and then your health savings account, which is going to take care of your medical expenses and premiums during your retirement years. Now, the good thing about dividend income is non-taxable until $47,000 for single or $97,000 for married. So you can withdraw up till these limits without incurring tax on your dividend income. And we are talking specifically about qualified dividends, that is dividend income coming from your investments or stocks that have been with you for more than 5 years. Going into phase 2 and phase 3, you will see the social security payments coming in. Now, as we progress onto the phase 2 and the phase 3, we do see that the need for income gradually reduces. So if you spent $10,000 a month before your retirement, those expenses are going to drastically come down to $7,000 or $8,000 a month during your first 5 years of your retirement, and then continue going down to maybe $6,000 or $7,000 and gradually to $5,000 as you progress along your retirement journey. So here is to summarize our deductions for 65 plus. We see 3 different kinds of tax deductions that can be applied to our taxable income when we turn 65. First is your standard deduction, which is currently now increased by a slight margin to $16,000 for single and $32,000 for married. Then comes your senior addition, which is $2,000 for single and $1,600 per married couple. Basically adds up to $3,200 per married couple. And then you have the One Big Beautiful Bill Act that was passed in 2025, which gives an additional $6,000 of deduction for a single or $12,000 of deduction for a married couple filing jointly. And this OBA is valid only until 2028. So that totally adds up to $24,000 of deductions for single and $47,000 of deductions for married. So which basically means that if you withdraw $47,000 from your 401k, it's entirely tax deductible and you are basically paying $0 in taxes on those $47,000 withdrawn. So the one exception to the One Big Beautiful Bill Act deduction is a phase out that has been applied. So if you are earning $90,000, which is basically $15,000 above the 75, you will lose $900 in tax deductions. But let's look at these 2 different paths of withdrawing your money post-retirement. So first path, you are paying $5,000 in taxes, whereas the second path, you're not paying really any tax on your income. And this is for an income of $80,000. Now in the first path, we are withdrawing entirely from our taxable income. $47,000 deductions applied if you're married and filing jointly. $43,000 is what will be taxed at 12% tax rate, which is basically $5,000, which ends up at 6% of your $80,000 income. Now the second path is you are dividing your withdrawal between your taxable and the non-taxable buckets. So the first is your taxable income of $47,000 from your 401k, SSN, asset sale, etc. Second, you're pulling out $33,000 from your non-taxable bucket, which is your Roth, your health savings account, and your dividend. And you definitely have $47,000 in deductions, which totally nullifies your taxable income withdrawal of $47,000. You end up paying $0 in tax. So these are the 2 different examples that I would like to bring to you, and you can actually see how this will work out if you are in one of these situations at the age of 65. Consider the implications of falling in higher income bracket based on your withdrawals from your retirement account. Now, IRMA, which is Income Related Monthly Adjustment Amount Surcharge, this is something that's going to apply on your Medicare Part B and Part D premiums based on tax returns from 2 years prior. So for 2026, they're going to look at your 2024 tax returns. And the current numbers are based on the 2023 income. So for individuals, the range is $106,000 or less, and for joint it is $212,000 or less in annual income for a standard premium to apply. And anything higher than this is going to put you in a higher premium. And if your income is as an individual exceeds $500,000 or as a joint exceeds $750,000 plus, you will be in the highest premium zone. So when we are looking at the income related monthly adjustment amount surcharge, we are basically looking at the modified adjusted gross income from 2 years prior. Now, common triggers for your IRMA are basically large withdrawals from your traditional IRAs, significant Roth conversions, or selling investments for large capital gains, or any one-time income spikes is going to affect the way your IRMA will apply on your Medicare and Medicare premiums. So now that we have looked at how the deductions are applied and understood the IRMA rules or the IRMA surcharge, let's take a look at the required minimum distribution or the RMDs. So RMDs will apply at the 73-year mark. It's mainly the minimum amount you must withdraw from your retirement accounts each year. You must start taking withdrawals from your traditional IRA, SEP IRA, Simple IRA, and retirement plan accounts like the 401k when you reach age 73. Now, the way to calculate RMD is basically the previous year-end balance divided by the life expectancy factor. Now, you can look up for the life expectancy factor. It's given out there. For age 73, it's basically 26.5, and then it keeps going lower, which mainly means your minimum withdrawal keeps going higher as you age. Now, RMDs are not applicable on Roth account. Now, this is a Vanguard calculator, which makes it super simple for you to calculate your required minimum withdrawals. So for a balance of $1 million, at the age of 73, you are required to withdraw $37,000 to avoid any penalties. Here is a quick recap of things that you need to do while planning your retirement strategy. Identify a reasonable estimate of your income need during retirement. Plan a well-balanced portfolio of taxable and non-taxable income streams to support your income need. Plan a phased withdrawal approach from your retirement accounts to avoid entering into a higher tax bracket, leading to IRMA surcharge, resulting in higher Medicare premiums. Plan to stay within your comfortable tax bracket while trying to maintain your RMDs, income from Social Security, stocks, or planned sale of any expensive assets. Thank you for joining this informative session on retirement planning. And if you feel this could help any of your friends who are in their 50s, 40s, 50s, or 60s entering into retirement or looking for advice on planning their retirement strategy, please share this video. Please like, subscribe, and follow me for more such informative content. Thank you for joining.